Okay, I hope I'm audible to all students who are attending this lecture of financial economics. We continue with our lectures on fixed income securities, which is the first topic within our broad lectures on investment theory and portfolio analysis. This is Unit 1, Investment Theory and Portfolio Analysis. So let's continue with our lectures on investment theory. Formally, this is chapter 3 of the book I prefer to follow for my lectures on fixed income securities. This is Investment Science by David G. Luenberger. Okay. Now, all students can recall that in the previous lecture, we were looking at some important terminologies relating to securities. We had looked at what is meant by a security, what is meant by fixed income securities with examples, what are the various kind of savings deposits we have, okay, what is meant by money market, what are the instruments traded in the money market, and we had in the last lecture also talked about the US government securities. We had talked about US Treasury bills, US Treasury notes, US Treasury bonds, and then we had also talked about US Treasury strips. Now in today's lecture, we continue with some more terms. So in today's lecture, we are going to continue with some more terminologies. Okay. And we are going to start with bonds now. So let's talk about other bonds. So other bonds are basically bonds which are issued by the agencies of the federal government. Again, we are talking about this in context of the US economy. So bonds issued by the agencies of the federal government, by state and local governments, and by corporations. All of us by now know what are bonds. Okay. So when we talk about other bonds here, these are basically the bonds that are issued by the federal government, state and the local governments and corporations. Now, within other bonds, you have the following categories. Category A, municipal bonds. Okay, so municipal bonds are those bonds which are issued by the agencies of the state and local governments. Okay, so municipal bonds are only issued by state and local government, and within municipal bonds you have two types. One is the general obligation bonds, which are backed by a governing body such as the state. One are the revenue bonds, which are backed by either the revenue to be generated by the project that will initially be funded by the bond issue or by the agency responsible for the project. So guys, when we talk about revenue bonds are those bonds which are backed by the revenue to be generated by that project for which the bond has been issued. Remember, firms and corporations issue bonds to raise revenue. That revenue is used to finance investment projects. So revenue bonds are exactly backed by the revenue which the project is expected to generate. Or they are backed by the agency who is responsible for the project. So again, you should conceptually understand and you should learn up these definitions. Okay. So I hope all students are clear with the municipal bonds. This was the first type of other bonds. Okay. Then coming to corporate bonds. What are corporate bonds? Corporate bonds are issued particularly by corporations for the purpose of raising capital for operations and new ventures. They vary in quality depending on the strength of the issuing corporation and on certain features of the bond itself. So whether the bonds issued by corporations will be good quality bonds or bad quality bonds depends upon how the corporation is performing, the strength of the issuing corporation. Okay, and corporate bonds are only issued by private corporations. They are not issued by the government. Government does not issue corporate bonds. They are only issued by private corporations. And these bonds are issued solely with the purpose of raising capital, either for the operations of these corporations or for making new investments, carrying out new ventures. Okay. So some corporate bonds are traded on an exchange, but most are traded over a counter in the network of bond dealers. Exchange is the formal market, okay, whereas a network of bond dealers would be the private network. These over the counter bonds are less liquid in the sense that there may only be a few trades per day of a particular issue. So corporate bonds are not highly liquid. That is what we learned. They are less liquid bonds because when it comes to the number of trades in a given day, okay, there might only be a few trades. Okay, and over the counter means they are all listed. These corporate bonds are listed on the formal exchange. Okay, so I hope that students have understood the features of corporate bonds. So we can now move forward. Okay. Okay, I want to make one more thing clear. When we talk about over the counter are basically those transactions which take place outside the formal exchange system, the stock exchange system. So when I talk about over the counter, I can write it here. So over the counter counter bonds are those bonds that are traded outside the formal stock exchange system, or I can say outside the formal exchange markets. So there's a private network. There's a private network of bond dealers where the corporate bonds are usually traded. They are not properly traded, or I can say listed in the exchange, in the stock exchange. Okay. So I hope all students are clear. A bond carries with it an indenture, which is a contract of terms. Some of the features are as follows. So all students should know that when we talk about buying or investing in bonds, then we have to look at the following features before investing in any kind of bond. So first is the callable property. Although we have done callable bonds in the previous lecture also, but you should know when is a bond said to be callable. A bond is said to be callable if the issuer, the party who is issuing the bond, has the right to repurchase the bond at a specified price. So that means when you see any bond to be having the callable feature, the party who has issued the bond to you can repurchase the bond from you at a specified price, and usually this call price falls with time. And often there is an initial call protection period wherein the bond cannot be called. So callable bonds are going to have the initial call protection period. In that period, the issuer has no right to redeem the bond. But after the call protection period is over, suppose I talk about a 5-year bond. Let's take an example to understand this. There's a 5-year bond which is going to mature in 5 years. Suppose I say that the call protection period is say 1 year. That means till 1 year, the issuer cannot ask you to give the bond back, in very simple language. But after 1 year, when the call protection period will be over, the issuer can ask for the bond back. The issuer can buy back the bond from you at a specified price going at that particular time. And usually this call price is going to fall with time. So that means when the issuer is going to buy back the bond from you, usually it's going to be at a lower price. Than the price at which it was issued. Okay, so this is the callable feature of the bonds. Okay, then we have sinking funds. Rather than incur the obligation to pay the entire face value of a bond issue at maturity, the issuer may establish a sinking fund. The sinking fund is going to spread this obligation over a time. That means instead of paying the whole face value at maturity, you are spreading your obligation over time. To do that, you establish something called the sinking fund. The sinking fund is going to make things more liquid. You don't have to shed a lot of money at maturity by paying the face value. You can spread your obligations over a period of time. So under such an arrangement, the issuer may repurchase a certain fraction of the outstanding bonds each year at a specified price. So every year the issuer from which you bought the bond, every year the issuer is repurchasing some part of it at a specified price. By doing that, it is paying for the obligation. So I hope students have understood the concept of sinking fund. Sinking funds are going to give liquidity to the issuer. They are going to give liquidity to the issuer. Why are they going to give liquidity? Because the issuer no longer has to pay the entire face value at maturity. What the issuer can do is that the issuer every year can buy back a certain fraction of the bonds at a specified price. It's like saying that suppose I am the issuer and I have issued the bonds to all my let's take the example. Suppose I am the issuer and I have issued the bonds to all my students. I'm just taking a very simple hypothetical example just to make all students understand the concept. I am the issuer and I am issuing the bonds to my students, and these bonds are 5-year bonds. They are going to mature after 5 years. Now, one option is that after 5 years, I pay the complete face value. But that is going to put a lot of burden on my pocket. So what I do is I make a sinking fund. In the sinking fund, what am I doing? I am I'm spreading my obligation. That means whatever face value I have to pay towards the end, I am spreading it over years by creating a sinking fund. So that means every year I am buying back from my students a certain fraction of the bonds by paying them a specified price. By doing that, I am paying my obligation, but not once towards the end, but gradually every year. And that is going to give me liquidity because money at once is not going from my pocket. Lesser amounts are going from my pocket every year. So instead of paying the whole big amount towards the end, I have created a sinking fund where every year I buy back from my students a certain fraction of the bonds by paying the price for them for that fraction. So I'm spreading my obligation over a number of years, giving me more liquidity as the issuer of bonds. Okay. Let's talk about debt subordination. This is the third term. Okay. So to protect the bondholders, limits may be set on the amount of additional borrowing by the issuer. Remember, guys, bonds carry default risk. The issuer can default on the bond. So that means in order to protect the bondholders who are buying these bonds, there has to be a limit which must be set on the amount which the issuer can raise through these bonds. Also, the bondholders may be guaranteed that in the event of bankruptcy, when the issuer fails to make the payments, payments to them takes priority over payments of other debt. Okay, so this is all debt subordination, and debt subordination is to protect the interest of the bondholders. Debt subordination is basically done to protect the interest of the bondholders. We need to set limits. We need to set limits on how much the issuer can borrow through issuing bonds. And we need to comfort the bondholders by guaranteeing that if the issuer defaults, then the payments to them will take priority over all other payments. That is what is meant by debt subordination. Only when the bondholder is guaranteed payments, that bondholder will be willing to invest in bonds at the first place. Okay, this was point 3. So I hope all students have understood this. So these are the 3 main features of the bonds. Callable bonds. If I quickly revise, a bond is said to be callable if the issuer has the right to repurchase at a specified price. And this call price falls over time. Usually there's a call protection period. Only after the call protection period, the callable property can be exercised, not before the call protection period. Sinking funds are basically funds which are created by the issuer of bonds to give them more liquidity. Instead of paying the whole big obligation at the end, they spread their obligation over a number of years by repurchasing a certain fraction of the bonds uh, at a specified price. Okay. And debt subordination is basically done to protect the interest of the bondholders. In this particular case, limits are set on how much borrowings can be done by the issuer of bonds. Okay. And in the event of bankruptcy, the bondholders are guaranteed that their payments will always be given more priority than any other payments. Okay. So now let us see what is meant by mortgages. Okay, so all of us know mortgage. Okay, we buy mortgages for homes also. We buy mortgages for automobiles also. So for a typical homeowner, a mortgage is just like an opposite of a bond. When you invest in a bond, you pay money for that, and after a certain period of time, you will get the face value of the bond. In case of a mortgage, you will have to, in case of mortgage, you will be given the money and then you have to pay back the money later at a specified interest rate. So you can think of mortgage and bonds are like heads and tails of the same coin. In case of bond, you pay the money to buy the bond and later you will get the face value and the interest on the bond. In case of mortgage, you get the money today and later you have to pay back that money along with the interest on. So it's like a loan, guys. Mortgage is like a loan only. It's actually a loan. So a future homeowner usually will sell a home mortgage to generate immediate cash flows to pay for a home, obligating him or herself to make periodic payments to the mortgage holder. These periodic payments are nothing but EMIs, equated monthly installments. The standard mortgage is structured so that equal monthly payments, or I can say EMIs, are made throughout its term, which contrasts to most bonds which have a final payment equal to the face value at maturity. Bonds usually give you the face value, and that too at maturity. On the other hand, in case of your mortgages, you are making equated monthly installments every month. Okay, so from the mortgage holder's viewpoint, the income stream generated is not completely fixed since it may be terminated within an appropriate lump sum payment at the discretion of the homeowner. So the homeowner can decide to pay off the mortgage before the time. So sometimes we do this, guys. We have EMIs, but sometimes we suppose I have made EMIs for, let's say, 5 years. Suppose I've bought an automobile and I have financed it through loan for 5 years. Now I can decide to pay off my loan within 3 years. So the bank who is holding the mortgage does not have fixed income, or I can say fixed payment stream. The income stream is not fixed means what? The income stream is not fixed means those homeowners who have taken the loan can even pay the loan before the tentative duration. It's like saying that suppose I have taken a loan for 5 years, I've taken a mortgage for 5 years, I can decide to pay it off within 3 years also. Okay, so it does not mean that I have to necessarily pay for 5 years. Whatever loan amount I've taken, if I pay it before 5 years, even that is fine. So in that particular sense, from the mortgage holder's point of view, the mortgage holder in this case is the bank from which I've taken the loan. The bank is holding my mortgage in this particular case. So if we talk about it from mortgage holder's point of view, the income stream is not fixed. The income stream is not fixed. Okay, so I can write here the mortgage holder in our example is the bank. You may terminate the loan with an appropriate lump sum payment before the stipulated period of time. And this happens a lot. Sometimes we tend to pay off the loans much before the stipulated period of time. Okay, so I hope all students have understood the concept of mortgages. They are exactly the opposite of bonds. The homeowner in this case obtains the loan from the bank, or I can say the mortgage from the bank. Okay, and the homeowner has to pay periodic payments to the mortgage holder, which is the bank. These periodic payments are nothing but EMIs, equated monthly installments. Okay, unlike bonds, which give you the face value at maturity, the principal plus the interest in the case of a mortgage is spread evenly across all the months. And from the point of view of the mortgage holder, the income stream is not fixed, because as a homeowner, you can decide to pay off your loan before the designated period of time. Okay, so I hope all students have understood this. So this is where I stop. We'll start with the concept of annuities in the next lecture. We are going to start with the concept of annuities, look at the calculation of what are perpetual annuities, calculation of the present value of perpetual annuities. All this we are going to take up for discussion in the next lecture. So I hope all students have enjoyed this lecture. Any doubt, you can unmute your mic and ask, or call up or mail me your doubts at divineschoolofeconomics@gmail.com. This is where I stop in this lecture.